January 30th, 2026, a date that will live in financial infamy. While you were probably arguing with someone on Twitter about whether pineapple belongs on pizza, the silver market experienced what can only be described as a coordinated assassination. In a single trading session, silver crashed 37%. 37%, from over $121 per ounce to $76, the largest single-day decline on record. But markets go up and down. You're thinking, that's just volatility, right? Wrong. So magnificently, catastrophically wrong. This wasn't volatility. This was a hit job. A carefully orchestrated takedown executed with surgical precision by the same financial institutions that have been systematically rigging the silver market for over a decade, then have the court documents to prove it. And here's the part that should make your blood boil. They've done this before. They were caught. They were fined $920 million for manipulating precious metals markets. And then they did it again. Because when you're too big to jail, you're big enough to do whatever you want. Welcome to the most audacious financial crime you've never heard about. Buckle up, this is going to get ugly. Let's talk about what actually happened on January 30th, because the mainstream media's coverage was, let's be charitable and call it, incomplete. Silver experiences volatility. Precious metals pull back. Profit-taking in commodities is the same as selling your Tesla shares because they went up 5%. Here's what actually went down. Spot silver crashed as much as 37%, the largest single-day decline on record. While COMEX silver futures slumped over 30%, their worst fall since March 1980. March 1980, the last time silver crashed like this, Silver Thursday, when the Hunt brothers tried to corner the silver market and the exchanges literally changed the rules to destroy them. We'll get to that delicious piece of history in a minute. But the carnage wasn't limited to the metal itself. The rout spilled into silver-linked exchange-traded funds where leverage magnified losses. In the US, the ProShares Ultra Silver ETF plunged nearly 60%, while the iShares Silver Trust ETF fell 29%, both suffering their worst day on record. Let me repeat that, 60% in one day. If you were leveraged long on silver, you didn't just lose money, you got financially obliterated. Your account went from 5 figures to 0 faster than you could say margin call. And here's where it gets interesting. This wasn't driven by some sudden discovery that silver is worthless. There was no negative fundamental news. Industrial demand didn't collapse. Solar panels didn't stop needing silver. AI servers didn't suddenly start running on hopes and dreams. In fact, physical demand for silver remained robust. Dealers were reporting premiums of $10 to $60 per ounce over the spot price. People with actual money wanting actual metal were paying up to $130 per ounce, while the official price said $76. Think about that. The paper market says silver is worth $76. The physical market where real metal changes hands says it's worth $130. That's not a market. That's a crime scene. So what triggered this massacre? Let me introduce you to the financial weapon of mass destruction known as a margin hike. On the weekend before the crash, the CME Group, the exchange that operates COMEX, where silver futures traded something they love to do, when prices get too high, they raised margin requirements. The CME Group moved to a percentage-based margin system in January 2026, hiking maintenance margins to 15% for standard positions and up to 16.5% for heightened risk. Translation: if you were trading silver futures on leverage, which is how most futures traders operates who suddenly needed WAY, more cash in your account, immediately don't have it. Too bad, your position gets liquidated automatically, whether you like it or not. The exchange effectively ended the era of cheap paper speculation that allowed traders to control 5,000 ounce contracts with minimal collateral, creating a margin trap to prevent a clearinghouse collapse as prices surged toward $120 per ounce. To prevent a clearinghouse collapse. That's the official explanation. Let me translate that from financial BS to English. We're about to run out of actual silver to deliver, so we need to crash the price before people notice we've been running a fractional reserve scam. This is the 2011 playbook. In 2011, COMEX raised silver margins 5 times in 9 days. Margins went from 4% of notional, which allowed 25x leverage, to 10%, which allowed 10x leverage. The leverage collapse triggered forced liquidation, and silver crashed from $49 to $26 in weeks. Same strategy, same result, same perpetrators. But wait, it gets better. President Trump announced Friday morning his intention to nominate Kevin Warsh as the next Federal Reserve Chair. A candidate markets perceive as significantly hawkish. Perfect timing, right? A hawkish Fed chair nomination that strengthens the dollar. Announced right as silver is hitting all-time highs right after the exchange raises margins. Kevin Warsh's hawkish Fed chair nomination strengthened the dollar and triggered forced liquidations across precious metals. Markets convenient, so very, very convenient. So who got destroyed in this massacre? Let's talk about the casualties. First, retail traders, the little guys. The people who saw silver's fundamentals, industrial demand, supply constraints, monetary inflation, and thought, hey, this makes sense as an investment. They got absolutely demolished. Leveraged positions liquidated. Stop losses triggered. Life savings gone. And here's the kicker. Many of them were right about silver's fundamentals. Industrial buyers need silver to build next-gen technology, and AI demand is causing structural disconnects between the paper and physical markets as these companies demand delivery. When the paper price crashed, it wasn't because demand vanished, it was because leveraged speculators were flushed out by spiking margin requirements. The actual metal is still in massive demand. The price just got adjusted by the people who controlled the casino. One report describes physical silver trading at premiums as high as 80%, with some transactions reaching $130 Oz, while COMEX spot sat around $71.50. Think about what that means. If you wanted to buy actual physical silver, the kind you can hold, the kind that exists in reality, you had to pay almost double what the official price said. It's a two-tier market. The paper market, where prices are determined by leverage, margin calls, and algorithmic trading. And the physical market, where actual supply and demand matter. And guess which market the mainstream media reports on? Guess which price you see on your investment app? That's right, the fake one. But here's where this story goes from corrupt to criminal. Because this isn't the first time, not even close. To understand what happened on January 30th, we need to travel back to 1980, to a time when 3 Texas oil billionaires tried to corner the silver market and almost succeeded. Meet the Hunt brothers, Lamar, William Herbert, and Nelson Bunker Hunt. These guys inherited a massive oil fortune and decided that, with inflation raging and the U.S. economy looking shaky, they should invest in something tangible, something like silver at its peak. The Hunt family owned about 1/3 of the world's supply of privately owned silver. 1/3, these absolute mad lads bought up so much silver that they controlled 33% of the global market. And what happened? Silver prices peaked at about $50 an ounce in January of 1980 before collapsing to just under $11 an ounce in March of the same year, from $50 to $11, a 78% crash. And it all culminated on March 27, 1980, a day that became known as Silver Thursday. So what happened? Did silver suddenly become worthless? Did industrial demand collapse? Nope. The exchanges changed the rules. New rules and regulations related directly to their speculative, leveraged investments forced them to begin liquidating their holdings. This ultimately helped lead to a massive crash in the price of silver. The COMEX and other exchanges implemented liquidation-only trading rules. You could sell, but you couldn't buy. They raised margin requirements. Sound familiar? Making it impossibly expensive to hold positions. Eventually, the Hunt brothers received a $135 million margin call that they could not fulfill, which was the beginning of the end. They were charged with market manipulation, fined hundreds of millions, banned from commodities trading for life. They declared bankruptcy. And silver? Silver would not breach the spike high for another 30 years. The message was clear. Try to corner the silver market, and we will destroy you. But here, asked the question nobody asked, if the Hunt brothers were manipulating the market by buying silver, what do you call it when banks manipulate the market by selling silver they don't have? Let me tell you about the biggest banking scandal you probably never heard about. Because unlike the Hunt brothers, these guys didn't go to jail. From 2008 to 2016, J.P. Morgan Chase, yes, that J.P. Morgan, America's largest bank, ran a systematic scheme to manipulate precious metals markets. And we know this because they admitted it. In court, under oath. In September 2020, J.P. Morgan entered a deferred prosecution agreement and agreed to pay $920 million to settle U.S. government probes into spoofing in precious metals and treasuries. $920 million, the largest fine ever imposed by the CFTC in a spoofing case. Okay, you're thinking, but what's spoofing? Great question. Let me explain how to rig a market in 3 easy steps. Step 1. Place a massive order to buy or sell silver in. Order so large it moves the market. Step 2. Watch as other traders see your order and adjust their positions accordingly. Step 3. Cancel your order before it executes and profit from the price movement you just created. It's fake, it's fraud, it's illegal. And JP Morgan did it hundreds of thousands of times. From at least 2008 through 2016, JPM, through numerous traders on its precious metals and treasuries trading desks, including the heads of both desks, placed hundreds of thousands of orders to buy or sell certain gold, silver, platinum, palladium treasury note, and treasury bond futures contracts with the intent to cancel those orders prior to execution. The heads of the desks? Let that sink in. This wasn't some rogue trader. This was institutional policy, a systematic strategy, a business model. Through these spoof orders, the traders intentionally sent false signals of supply or demand designed to deceive market participants into executing against other orders they wanted filled, and it worked. Oh boy, did it work. According to the order, in many instances, JPM traders acted with the intent to manipulate market prices, and ultimately did cause artificial prices. Artificial prices. The market price you saw for silver from 2008 to 2016, fake, manipulated, a lie. But wait, it gets even better. One of their traders, John Edmonds, pleaded guilty and admitted that he, along with other unnamed co-conspirators at the bank, manipulated the prices of gold, silver, platinum, and palladium futures contracts from 2009 to 2015. He said he learned how to make bogus trade orders from senior traders at the bank and that he used the strategy hundreds of times with the knowledge and consent of supervisors. With the knowledge and consent of supervisors, this went all the way to the top. And it wasn't just JP Morgan. Between 2016 and 2025, global banks, including JP Morgan, UBS, HSBC, and others, paid over $1.2 billion in spoofing-related fines, and multiple traders were convicted for placing fake orders to manipulate prices. $1.2 billion in fines, that's not an oopsie, that's a business expense. Now let's talk about the elephant in the room, or more accurately, the imaginary elephant that exists only on paper. Here is how the silver market is supposed to work. You buy a futures contract representing 5,000 ounces of silver. When that contract expires, you can either roll it over or take physical delivery of the silver. Simple, right? Except for every ounce of physical silver available, there may be hundreds of ounces represented by paper contracts. Some estimates place the ratio at 400 to 1 or higher. 400 paper ounces for every 1 physical ounce. Let me put that in terms even a toddler could understand. Imagine a casino where 400 people have chips representing the same $1 bill. As long as only a few people cash out at a time, everything's fine. But what happens when everyone tries to cash out at once? The system collapses. Current estimates suggest ratios between 50 to 1 and 100 to 1, meaning futures contract values dwarf annual physical silver production. Even the conservative estimates say the paper market is 50 times bigger than the physical market, and this creates the most absurd situation in modern finance. The paper-to-physical ratio amplifies the effect. Current estimates suggest this ratio stands at 378 to 1, meaning paper claims far exceed actual silver available. You have a market where the price is determined by paper trading that has almost nothing to do with actual supply and demand of the physical metal. Over the last few days, there has been an almost $5 Oz arbitrage between paper and physical between East and West. The Shanghai exchange where physical delivery is more COMEX pricing. Silver, $5 higher than COMEX, but here's where it gets truly insane. In less than 24 hours, the China silver export ban officially went into effect. This policy, which impacts approximately 70% of the world's physical silver supply, fundamentally altered the global flow of metal. 70% of global silver supply just got cut off from Western markets. And what happened to the price? It crashed. Supply constrained, demand strong, and the price goes down. It's not a market, that's manipulation. So let's put this all together. Because once you understand the mechanics, you'll never look at market prices the same way again. Here's how you manipulate silver in 2026. Step 1. Build massive short positions. Large financial institutions can accumulate substantial short positions in silver futures without corresponding physical holdings. Concentrated short positions create persistent downward pressure. You don't need to own silver to sell it. You just need to convince the market you're selling it. Step 2. Wait for prices to rise. Let natural demand push prices up. Solar panels need silver. EVs need silver. AI data centers need massive amounts of silver for components and cooling. Industrial demand is real, so prices rise. Silver hits $80, then $100, then $120, all-time highs. Step 3. Spring, the trap coordinate with the exchange to raise margin requirements, announce hawkish Fed policy that strengthens the dollar. Dump massive sell orders into the market, trigger stop losses, and forced liquidations. Watch the cascade. The hypothesis is that the ultra-wealthy are triggering mass liquidation by dumping huge quantities of future contracts, overwhelming buy-side liquidity, and thus crashing the price. This creates a cascading effect of forced liquidation. Retail investors must post more cash or risk auto-liquidating. Then there will be a brief reprieve, and then again crash to wipe out the remaining investors. Step 4. Cover your shorts now that you've crashed the price from $120 to $76. You buy back the silver you sold at $120, except you rebuying it back at $76. That's a $44 profit per ounce on positions worth hundreds of millions of ounces. Do the math, that's billions in profit in one day. And here's the beautiful part. The physical market doesn't change. Industrial users still need silver. Dealers still charge premiums. Real supply and demand haven't shifted. You just extracted billions from speculators and investors by manipulating paper contracts. Then you wait for prices to recover, build your short position again, and do it all over. It prevents gold and silver from revealing the fiat currency weakness as the dollar fiat regime is heading towards a fall. Because if silver reveals its true price based on actual scarcity and demand, people might start questioning the value of their dollars. And we can't have that, can we? So where were the regulators while all this was happening? Great question. The Commodity Futures Trading Commission, the CFTC's, supposed to police the futures markets. Their entire job is to prevent manipulation and ensure fair trading. And they did catch J.P. Morgan after 8 years and fined them $920 million. Problem solved, right? Markets are fair now. Yeah, about that. January 30th, 2026 would like a word. Despite numerous red flags, including internal surveillance alerts, inquiries from CME and the CFTC, and internal allegations, JPMs failed to identify, investigate, and stop the misconduct. The CFTC had surveillance alerts, they had inquiries, they had internal whistleblowers, and it took them 8 years to act. And when they finally did act, deferred prosecution agreement, which means pay us money and promise not to do it again. No criminal charges for executives, no jail time, no banning from the industry. The traders who actually executed the trades, some got charged, but the executives who oversaw them, the people who created the system, they're still running major financial institutions. Better Markets called the payment a sweetheart deal and a miscarriage of justice, adding that it penalizes only J.P. Morgan shareholders and not executives or other employees that may have been involved. Think about that. When J.P. Morgan pays a fine, who really pays? The shareholders, the pension funds, the 401ks, the people who committed the crime. They keep their bonuses. And here's the uncomfortable truth. The CFTC is understaffed, underfunded, and outgunned. They're bringing a knife to a gunfight. They're trying to police markets that trade millions of contracts per second, using algorithms so complex that even the people who wrote them don't fully understand them. It's like asking a mall cop to arrest the Avengers. Now let's talk about the mainstream financial media. Because their coverage of the January 30th crash was illuminating. Pull up any major financial news site the day of the crash. What do you see? Silver experiences volatility. Fed nominee strengthens. Dollar profit taking in commodities. Notice what's missing. Any mention of manipulation, any questioning of margin hikes, any discussion of paper versus physical divergence. Meanwhile, on Twitter, retail investors are doing actual analysis, comparing physical premiums to paper prices, tracking warehouse inventory, documenting the timing of margin hikes. They're doing the journalism that professional journalists won't do. Why follow the money? Who advertises on financial news networks? Banks, investment firms, the very institutions being accused of manipulation. Who do they invite as experts? Bank executives, analysts from the firms doing the manipulating. It's like asking the fox to investigate the henhouse massacre. When retail investors band together to buy GameStop, it's market manipulation that needs to be stopped. When banks systematically rig the silver market for 8 years, it's complex trading strategies. We saw this in 2021 when Wall Street Silver initiated the silver squeeze. The CFTC admitted they had to manage the price, as $30 Oz was an inflection point. Manage the price. Let that phrase sink in. The regulator admitted to managing, i.e. manipulating the price, to prevent it from going too high. Changing the rules to benefit the casino will happen again when the price goes too high and they make it expensive. It's not a conspiracy theory when they admit it on record. So where do we go from here? Because this story isn't over. Not by a long shot. The silver market is currently experiencing something unprecedented, a complete decoupling between paper and physical markets. Physical dealers adjust premiums based on manipulation expectations. In late December, physical silver prices in several key markets were significantly higher than paper, premiums ranging from $10 to $60 per ounce. That gap is getting wider, not smaller, wider, and industrial demand isn't slowing down. If anything, it's accelerating. Solar panels. Silver is irreplaceable in photovoltaic cells. Electric vehicles. Each EV needs 25 to 50 grams of silver AI data centers. Massive silver requirements for components and cooling 5G infrastructure. Silver is essential for high-frequency applications. Meanwhile, supply is constrained. Mining production is relatively inelastic. You can't just make more silver quickly. New mines take years to develop. And with China restricting exports of 70% of global physical supply, the shortage is about to get a lot worse. So what happens next? There are 3 scenarios. Scenario 1, the paper market collapses. Exchange delivery failures would immediately escalate market stress. If COMEX or LBMA cannot fulfill delivery obligations on expired contracts, it signals system breakdown and likely triggers vertical price moves. The paper Ponzi scheme unravels. People demand physical delivery. The exchanges can't deliver. Forced cash settlements, market chaos. Price discovery moves to physical markets where actual supply and demand determine prices. Scenario 2, the status quo continues. They keep using the same playbook. Raise margins when prices get too high. Coordinate with hawkish Fed announcements. Trigger forced liquidations. The manipulation continues until it doesn't, because you can't suppress physical reality forever. Scenario 3, the grand reset, something bigger breaks. Maybe it's silver. Maybe it's another market. But the fractional reserve paper game collapses across multiple commodities. This triggers a reevaluation of all paper claims versus physical assets. Based on the widening physical premiums, the increasing industrial demand, and the supply constraints from China's export ban, we're looking at 6 to 18 months before one of these scenarios plays out. The paper market can't hold much longer. The cracks are showing. So what does all this mean for you, whether you own silver or not? First, understand that if they can manipulate silver, a market worth hundreds of billions, what else are they manipulating? Gold, obviously. Oil, probably. Interest rates. The Treasury market itself admitted JP Morgan was spoofing Treasuries too. The prices you see on your screen for anything might not reflect reality. They reflect what powerful institutions want you to believe. Second, the difference between paper and physical matters. A lot. If you buy physical silver, you own metal. It's in your possession. No counterparty risk. No chance of a broker declaring force majeure and settling your position in cash. If you buy a silver ETF or futures contract, you own a promise, a claim, a piece of paper that says you own silver. And, as we've seen, those claims can be worth very different amounts depending on whether you try to convert them to actual metal. As Canadian mining investor Frank Dustra stated, if you only have paper gold, you do not really own gold. When a crisis comes, that gold will not be there. Replace gold with silver, and the statement stands. Third, if you're thinking about exposure to precious metals, understand the game you're playing. The paper market will continue to be manipulated. Prices will be suppressed. Volatility will be manufactured to shake out weak hands. But the physical market, that's where reality lives. That's where actual supply and demand matter. And over the long term, reality always wins. You can manipulate prices for years, even decades. But eventually, the physical market asserts itself. Silver had two similar blow-off tops. In 1980, with the Hunt brothers, silver topped and wouldn't breach the spike high for another 30 years. After the early 2000s, the China-driven bull market ended in 2011 in blow-off top form. Silver wouldn't make another high for 13 years. The pattern is clear. They let it run, then crash it, then suppress it for years. But this time might be different, because this time industrial demand is structural, not speculative. This time there's a physical shortage that can't be papered over forever. Here's what I want you to understand. This isn't about silver, not really. Silver is just the most obvious example of a system that's broken at its core. A system where prices can be manipulated with impunity. Criminals pay fines but face no jail time. Regulators are captured by the industries they're supposed to police. Media coverage protects the powerful and retail investors are treated as prey. We saw this in 2008. Banks made fraudulent loans, packaged them as AA securities, crashed the global economy, and got bailed out. No executives went to jail. The system continued unchanged. We saw it again in 2023 when regional banks collapsed due to the same risky behavior. What happened? Bailouts. Systemic risk. Too important to fail. And we're seeing it now with silver. 8 years of documented manipulation. 920 million Australian dollars fine that represents a rounding error in annual profits. And then they did it again. Because there are no consequences, not real ones. You know what would stop this? Criminal prosecution, executives in handcuffs, perp walks, prison time, personal liability. But that would require a system that actually enforces laws against the powerful, and we don't have that system. We have a system where retail investors get margin called and liquidated, while the banks that cause the manipulation use the resulting price drop to cover their shorts and book massive profits. A system where your losses become their gains. But here's the thing, they can control the paper market. They can rig the futures exchanges. They can coordinate with regulators and media. What they can't control is reality. They can't make more silver appear out of thin air. They can't stop solar panels from needing it. They can't prevent EV manufacturers from demanding it. They can manipulate the price, but they can't manipulate physics. And every day that passes, the gap between paper fantasy and physical reality grows wider. History is clear. Price suppression schemes always eventually fail. The Hunt brothers tried to push prices up artificially. The system destroyed them. But the system is also trying to push prices down artificially. And that scheme will fail too, because you can't suppress a genuine shortage forever. The question isn't if the paper market breaks. It's when. And when it does, the people holding paper promises are going to learn a very expensive lesson about the difference between price and value. So the next time someone tells you markets are efficient, fair, and regulated, the next time someone says conspiracy theories about market manipulation are just paranoia, the next time someone insists that the price you see on your screen reflects true supply and demand, remember January 30th, 2026. Remember the $920 million JP Morgan paid for 8 years of admitted manipulation. Remember the 37% crash that happened while physical demand remained strong. Remember the 400-to-1 paper-to physical ratio that nobody wants to talk about. This isn't a conspiracy theory. This is a conspiracy fact, with receipts, with court documents, with convicted traders and historic fines. They rigged the game. They got caught. They paid the fine. And then they did it again. Because in a system where crime pays and consequences don't exist, why would they stop? If this video just completely rewired your understanding of how markets actually work, you need to subscribe. The manipulation continues because most people don't know it's happening. Share this video, make it viral, make it impossible to ignore, because the only thing more powerful than their manipulation is people knowing about it. Until next time, stay skeptical, stay informed, and maybe consider what price really means in a world where paper can be printed infinitely. But physical resources can't. See you in the next one.